U.S. Insider, a premium edition of the Financial Sense News Hour. Today's host is Senior Editor Chris Sheridan.
Joining us on the show today is Jim Roemer. He's the president of Best Weather and author of the Weather Wealth newsletter. And Jim, I want to start off with inflation. We are going to talk about the impact that weather is having on commodities, of course, but inflation in the U.S. came in at 7.1% in the fourth quarter of 2021. It's the highest reading we've seen in 40 years. And of course, this isn't just a problem in the U.S., but across the entire world when it comes to food, gas, and electricity, basically cost of living everywhere. Most of the guests that we have had on believe we'll see inflation peak this year, perhaps this quarter or next, but likely remain at higher than average levels for the long term. And there are a lot of factors that are going into this, of course, including weather. What is your outlook on what is probably the most pressing and important issue facing policymakers right now?
Yeah, I mean, obviously the Fed is taking measures now to raise interest rates, kind of cool inflation. But historically, if you go back to the 1970s and other periods of inflation over the last 50 to 100 years, even though rates may be going up here several times over the next 6 months to a year and a half, we will still have above average inflation compared to the last 15, 20 years, probably well into at least the first half of 2023.
Let's move into some of the things that are really leading to this big jump in inflation. If you look across the board, whether or not it's in Europe, whether it's in US or globally, energy is a major factor. What are you seeing on the energy front currently when we look at the big spike we've seen in natural gas, coal, oil, or the like?
Yeah, it's interesting because if you go back to the 1970s, I mean, crude oil was higher than where it is right now. And also there was a spike to, I think, $150 a barrel, about 7 to 10 years ago. So historically, some of these energy prices are actually lower. You compare that to college education, which has gone up 1,000% the last 20 and 30 years. Yeah. We're actually below levels back in the 1970s. But currently, yes, we have a squeeze in several commodities, obviously because of COVID-19, all this pent-up demand. What's going on between the Ukraine and Russia right now causing concerns about military action. That's helped the price of crude oil as well. We're going in the weather. Yes, we've had a really big switch from a record warm December to a record cold January right now that may continue through February and March. With all this new technology to export what's called liquid natural gas, LNG, to Europe, that combined with this very cold second half of the winter has created a spike in natural gas and also the heating oil market.
Tell us about what we're seeing inventory-wise. I had our CIO just download some charts from Bloomberg on what he's seeing for 5-year averages for heating oil, coal, natural gas, gasoline, and oil. And it looks like across the board, regardless of what form of fossil fuel you're looking at, they're all below 5-year averages. And there has been a lot of talk about the market being quite tight at this point. So, anything, if that's a cold spell, a cold snap like we see right now hitting the East Coast and down into Texas, of course, or if it's uncertainty and geopolitical tension over Ukraine, all of these are adding on top of an already tight market.
Yeah, part of it is less expansion of shale production, a potential green economy that's actually occurring around the world, which is creating some switches, obviously, to renewables and putting even tighter supplies into the crude oil market. Crude oil, gasoline, and heating oil is still incredible demand around the world. That's not going to be abating anytime soon. So we're seeing less real development of new plants, new technologies, to produce more heating oil and natural gas. That combined with a cold winter in Asia and the United States is certainly putting a squeeze in some of these commodities right now.
Now, it looks like heating oil is probably the most tight. For 2022, we are below the low of what we've seen over the last 5 years and well below 5-year average. Is that what you're seeing as well?
Yeah, and that was one of my best trades I've discussed in my Weather Wealth newsletter back in December. Buying heating oil and selling gasoline. Why is that? More people beginning to fly now, more countries opening up. Heating oil is also used in airplanes, of course, diesel fuel, but also the primary fuel in the Northeast U.S. and in parts of Europe and Asia. And with this cold spell, what you're seeing is a spike up in heating oil. Gasoline prices have actually lagged. For example, this snowstorm in late December that affected the Northeast U.S. and all the way down the coast into Georgia, millions of people couldn't drive for several days. So actually that put pressure on gasoline prices relative to heating oil. So we've seen what we call that spread really widen, and that could continue into February and March. particularly if we get more really severe weather, a lot of snow that shuts down driving, and that boosts the heating oil market.
Let's talk about food prices, because obviously food is affected directly by the weather. And if you look at the UN Food and Agricultural Index, it is back up to the record highs that we saw in 2010, 2011. It was during that time where we did see a number of different protests break out over food prices. We're back up at those levels again. And as I said in the very open, cost of living increases are hitting everyone globally. This is not just a US or Europe issue. This is across the board. So what are you seeing in food prices, and what are some of the particular areas where you're seeing the highest increases?
Yeah, Chris, the last big explosion in food prices occurred around the 2010 era of spring. I mean, there were protests and wars because there were droughts all over Asia and Russia and the United States simultaneously. And we saw like a 50 to 100% increase in corn and soybeans and wheat. That could certainly happen here again. Right now, we're seeing one of the worst droughts in about 10 years in South America. Brazil and Argentina produce more than half of the world's soybean and also corn crop. They've been devastated by some hot, dry weather recently. There's flooding in northern Brazil that's coming on the heels of a drought that affected coffee prices, freezes last year, and droughts, and now flooding for the coffee harvest. So you have all this coming together in the southern hemisphere, and our spring and summer in the northern hemisphere will be dictated pretty much by what La Nina does. Some computer models are suggesting La Nina eases. If that's the case, we go more toward a neutral situation, kind of a normal ocean temperatures in the Pacific. Then we can have record crops this next summer and see the food market actually go down, at least in grains and some of the other ag commodities. But if La Nina continues, and that's a possibility, this volcano you heard about a couple of weeks ago, one of the largest ones ever underwater, that's cooled the Pacific Oceans and actually could create a longer type of La Nina event. If that happens, we could see more of an explosion in grain prices going into the spring and summer of 2022, in the next 3 or 5 months.
Yeah, and do you mind clarifying on that? What is it about the volcano exactly that would lead to a bit of some cooler conditions? Is the amount of smoke and particulate matter that's released into the atmosphere that reflects the sunlight? Is that basically what's happening there?
A little bit different. You go back to the Tempora volcano and also Krakatoa back in the 1800s, which cooled the stratosphere and created, years without summers. So that's how the Farmer's Almanac got its nickname, I think, back in the mid-1800s. It snowed in New York in June and July. They inadvertently forecasted this, and they were right. Those volcanoes, we don't have the severity of them as much. I personally believe with fossil fuels and everything else that the climate is really, really warm, that a major volcano will not necessarily cool the planet longer term like it did back in the 1800s. What it has done over the last 2 or 3 weeks is create these incredible tsunamis down in the Pacific, the South Pacific. And that's happened is what we call gravity waves. Without going into too much detail, it's created upwelling, bringing the cool waters from hundreds of feet down on the ocean floor up to the surface. And that's extended the cool tongue off the coast of Peru out into the Central Pacific. And as a result, it could take several more weeks or even a month or two before that begins to warm up again, which could extend La Nina into the May through July timeframe. And again, cooling oceans off the Pacific along the equator, La Nina tends to, like 70% of the time, cause a reduction in grain yields during the spring and summer in the Northern Hemisphere.
Interesting. Okay, so you're saying that the Tonga volcano, that massive eruption that we saw, a lot of that cooling is going to come from the upwelling of the colder waters towards the bottom of the ocean up to the surface. So that's really the main driver there.
Yeah, I mean, it's really a short-term thing, but it could prevent the oceans from warming like they normally do in the spring and summer by an extra 4 to 6 weeks. Well, you take 4 to 6 weeks longer La Nina pattern in the May through June, July timeframe when crops in Asia and Russia and the United States are pollinating or developing, the primary time of the year for yield development in the summer. And that can make the difference of above normal yields and 5 or 10% below normal. That happens, there would be another surge in grain prices over the course of the summer. One other point I want to make is that you talk about inflation. In certain areas, inflation is more like 20 to 30% the last year. But I think the Fed's trying to kind of camouflage that a little bit. Look at housing prices. Look at the bottlenecks of goods around the world. Look at, I'm not into forecasting this, but college education, right? All these other situations where inflation has absolutely just soared is well above the 7% level. Commodities, some of them are up 25 to 100% over the last year. So, this is a pretty serious situation with inflation right now. I think it's worse than actually many people feel. And it could take, as I mentioned before, a couple of years before things begin to change.
Yeah, that is our view as well. And like you said, there's perhaps a bit of masking of some of the underlying forces here. You named one of the big ones, which is rental price inflation. That's one of the largest components of the CPI, and it was notably absent from the numbers for quite some time. But we know rental prices are increasing double digits. They lag home prices. And so as long as home prices continue to go up, rental prices also move up. That is putting a lot of pressure on inflation, lifting inflationary pressures. That's not really made it into the statistics as much as one would think. So we think that is going to continue to exert upward pressure on official CPI number, like you say, for some time, unless we were to see some major crash in the housing market. And, I'm sorry to say, but there's just not enough supply out there right now. That could change, but it doesn't seem to be changing anytime soon with the amount of regulations that we see with the supply and chain bottlenecks and getting not only workers, but materials. So it's not like the quick reversal that we saw in 2005 with supply just coming on board dramatically and sending prices down. So yeah, there's a lot of things I think do lead to a longer term outlook for inflation, which it sounds like you agree with. Can you tell us a little bit about something that you talked about in your recent report, and that's backwardation, what that is and the role that that's playing in the commodities market currently?
Backwardation tends to exist when there's a squeeze in commodities in the near term. And typically, the nearby contracts and commodities are higher than the deferreds. Usually it's the other way around, it's contango, but it's such pent-up demand right now. You're seeing squeezes in, crude oil, pent-up demand, for soybeans right now because of droughts and everybody wanting bread and soybeans around the world. So that's been happening. A lot of commodities when inflation tends to ease or when there tends to be less bottlenecking or global weather disasters, then you'll begin to see the deferred contracts 3, 6, 12 months down the road actually higher price than the nearby contracts. That's because of carrying costs, et cetera. Usually the deferred contracts are a lot higher. So right now, like for example, if we have a big squeeze in natural gas, if there's panic with LNG exports and to Europe and also very cold weather in February and March. For example, the March contract may be higher than, say, the June or July contract. There's a squeeze in the short term, and that's happening probably because of the weather.
Basically, that means when you see commodities moving in backwardation, that means supplies are tight, right? And there's, the future contracts are higher than the current contracts.
That's right. In the cash market. That's right. Because all the end users, all the commercials are buying futures, panicking about maybe a squeeze in higher cash prices. So very often the nearby contracts are higher than what the cash market is, if that makes sense. And so you're getting all these the buying from commercials, from industries, from speculators, and that's been happening in a lot of commodities lately.
Right. And again, I think, as most analysts would agree, we are looking at a tight market, below 5-year averages on inventories across the board for most fossil fuels right now, heating oil in particular being the most tight. Coal also actually seeing a lot of tightness, and we did see some major shortages last year, which led to price spikes in coal, natural gas, as people are racing to get their hands on those inventories. I want to ask you about your outlook on commodities more broadly when we think about this idea of a commodity super cycle. We have seen, I would say, really since after the COVID crash, we've seen this very strong rally in the commodity complex, in the energy market, of course, once we hit lows and negatives and negative prices in some cases in oil. But do you buy into this commodity supercycle thesis that Jeff Curie at Goldman Sachs and others are saying, or any thoughts on the outlook there?
Yeah, I certainly do. I mean, at least maybe for the next year and a half until inflation cools off the economy. And we haven't had a super cycle for quite a long time. Look at the charts, technical analysis on combined with what's going on with all the bottlenecking, weather problems, and just pent up demand. And we are in that cycle right now that could continue, not in all commodities, but maybe at least half of them over the next 12 to 18 months. Though this is not weather, of course. Indirectly, maybe it is with if you believe in climate change, the global green economy. There's so much demand for tin, for aluminum, for other precious metals that will be used in electric cars, for carbon capture, things like that. We could be well into a super cycle for those commodities, well for the rest of this decade. That's certainly a very good possibility. I think, and grain prices potentially, if we have another drought, could be in for a major super cycle here through the summer.
It's really interesting. We were just talking to a guest who's a resource mining analyst, and we were discussing how we're not only seeing a global supply crunch on fossil fuels because of the lack of investment that has been going into that area in recent years, also the political pressure, ESG pressures, lack of expanding production. So we see, again, we're below 5-year average on most inventories in the fossil fuel sector. But we also see a global supply crunch for a lot of these green energy or green economy metals as well. So it seems like on both sides of the energy transition, there's a global supply crunch because, like you said, I mean, there is soaring demand for all sorts of these different things, whether or not it's copper or lithium or graphite, all of these green energy metals. And unfortunately, most of the refining and processing of these come out of China. And there's a big bottleneck there as well. It's not a good situation.
It's actually, for Greenland, it's kind of bittersweet. Obviously, the warming planet that we've had a cold winter this year, nothing like they were 30 to 50 years ago. Greenland is sitting on a huge amount of these rare earth metals, for example, lithium. Well, unfortunately, these icebergs begin to melt more and more, and the land's exposed. They can harvest all this stuff and compete with China in the global market and produce a ton of this stuff, which will help their economy. So you have, unfortunately, melting glaciers, sea level rise in Greenland, but they can benefit from the rare earth metal boom potentially over the next 10 to 20 years. They're actually sitting on a gold mine potentially of these rare earth metals.
Yeah, and it'll be interesting to see if they can actually get that through because, again, the same forces that we see globally of against the mining industry we see as well. At least this is a headline that had come out last year about Greenland preparing legislation to halt their large rare earth mines. So there's a lot of pressure against the mining sector. We need these metals, but at the same time, we don't want to mine them. So that's leading to an uptick in prices globally as well. I don't know if people are thinking these things through very well. But
interesting. I know that. I know in the Pacific, there was something on 60 Minutes a year or two ago about a lot of rare earth metals. I forgot which ones, well under the Earth's crust out in the Pacific Ocean and ways to potentially harvest them. Obviously, I don't want them to kill the dolphins and the whales and destroy the environment. But I think we have the potential in the deep oceans to potentially compete with the Chinese and some of this over the next 10, 20 years.
Yeah.
There's a way to harvest them without destroying the environment. So
Right. And that's the problem. It's still dirty, right? I mean, you can make it less dirty, but it's still a dirty industry. And so, it's how much regulations are you willing to forego or pare back in order to make it something that we can do. And we'll see if economics or environmental concerns weigh out in the end. But I think that's still an open question.
I'm using the wrong word, harvest. You can see that I lived in the Midwest for too many years, watching corn and soy. You don't harvest trace metals,
Right.
But
you
certainly harvest grains anyway.
yeah. Extract and mine them. Right.
Extracting, yes.
Well, Jim, as we close today, it sounds like in alignment with our view, you believe that inflation will remain at higher than average levels for the years ahead. There's a lot of reasons for that. It doesn't sound like you're overly bullish on the energy complex, but as far as probably drill down in specific sectors, we do see heating oil as the tightest of all the different fossil fuels out there. Food, you said that we could see continued spikes in food prices if we were to see this colder than average weather continue into March. And as far as the commodity sector, the super cycle thesis, it looks like you do expect that likely to play out for another year or two. Did I get that correct?
Yeah, I certainly do. I think we're going to continue to see tight supplies of natural gas and heating oil and crude oil. We may stay in a bull trend for a while. I don't think it'll exist longer term. I may be wrong, but I think in some markets like cotton, for example, incredible demand, corn, soybeans, wheat, cocoa, there's a drought developing in West Africa. They produce 2/3 of the world's chocolate. Depending on La Nina versus El Nino, we could be in a boom in cocoa prices over the next 12 to 18 months. So that, and also some of the precious metals, particularly silver, and gold's not a hedge anymore against inflation like it used to be because of Bitcoin and everything else. But some of the other precious metals used in the global green economy, silver, for example, I think they could stay in a super cycle well into the next, maybe for the rest of this decade, at least for the next couple of years.
Yeah, there are forecasts for 3 to as high as 8 to 9-fold increases in demand for a lot of these green type metals or battery metals. So yeah, that unless we see massive supplies come on board and perhaps some deregulation efforts, at least here in the U.S. and elsewhere where we see these deposits, prices are likely to remain high.
There's a couple trace metal ETFs. I think one's called REMX, I believe. That's, I think, sold off 30 to 40% here over the last few weeks. I think because a lot of speculators got into that market, expecting this big bull move and incredible demand and trace metals, et cetera. Some of these are really good buying opportunities because eventually I think demand's really going to pick up. There's carbon capture companies like Fuel Cell, for example, Bloom Energy. Right now they're not showing a lot of profits, but in the next 10 to 15 years, they certainly will. So I'm sure your firm has looked at a lot of that, but there's probably some really diamonds in the rough right now that have potential explosion and a potential, boom cycle here because of the global green economy and the ESG investing that has become more to the forefront in people's minds. It's important to kind of save the planet and do these kind of the right things, so.
Short term, we're definitely seeing risk off with, the major indices down pretty big. And it looks like we are putting in possible head and shoulders top on the major indices. So short term, it's hard to say, but there are definitely some long-term investment themes here when we talk about batteries and EV metals and a lot of things that we discuss. So Jim, it's always a pleasure to have you on our show. As we close, can you tell us a little bit more about what you do at Best Weather and your Weather Wealth newsletter?
Yeah, thanks. So for 20 years, I was advising a hedge fund in New York City. It was one of the most successful ones in the world. They kind of folded shop. The CEO kind of retired, got up there in his age. And so I started this newsletter about a year and a half ago, 2 newsletters. One's called Weather Wealth that gives twice a week weather, both short and long-term forecasting and commodity advice to farmers and traders all over the world in multiple commodities. And my less expensive newsletter, Climate Intelligence, is more educational. Talked about the volcano recently, how it affects La Nina. It's some generic longer-term ETF strategies. Again, the Weather Wealth one is sent out twice a week for very active traders. So I started doing this, and it's really grown. And I've had clients all over the world, from natural gas producers to grain traders in Australia to the novice, commodity investor in New York that has been trading stocks for 40 years and wants to learn about commodity trading. So ETFs are a great way to get your feet wet in commodities if you don't have the experience or the temperament to handle some of these extraordinary moves and volatility that often happens in the commodity markets.
Well, once again, that's bestweatherinc.com, and we'll have some links and material where this interview is posted on Financial Sense, so all of you can access those as well. Jim, it's a pleasure speaking with you on our show. Look forward to having you on in the future. If you have any questions or feedback on what we discussed today, or if you'd like to get in touch with us about our asset management or financial planning services, you can do so by going to financialsense.com and clicking where it says Contact Us. As always, don't forget to spread the word about FS Insider with your friends and family and share our podcast on all of your social media channels. For FS Insider, I'm Chris Sheridan. Thanks for listening.